How are you, my friends? The recent rising 10-year bond yields caused some fear to the stock market. In this video, I will talk about why the 10-year bond yield increased. How should we decide buying value stock and growth stock? I will also mention both types of ETF and stocks. Okay, let us begin. Will the rise of 10-year bond yield crash the stock market next week? Many people face a whole week of market crash as the yield increased to 1.6%. Are you scared? Should we avoid growth stock and only buy old economy stocks? Rising 10-year bond yields have an adverse effect on stocks. In addition to high inflation expectations, it also reduces the attractiveness of stocks. In fact, bonds and stocks are competitors to each other. Because professional investors all over the world have bonds and stocks in their portfolios, these two asset classes will compete with each other in the portfolio. How should we deploy the next investment? By the way, since I provide information for free, please show your love by like, comment, and subscribe this channel to make this channel grow. I will share today some macro views on the stock market. The vaccination coverage is increasing. The high-risk people such as medical staff are protected now. In addition, the transmission rate of the virus is lower in summer. With the mass production of vaccines, many countries are able to achieve the goal of vaccinating most of the population within this year. The government and medical science experts will have a consensus to open the economy. Reopening indicates that the money from the fiscal stimulus that the government has been issuing will start to be released to the real economy. In many countries, the initial stage of economic expansion is taking shape. Reflation, this word has been rare in the past years. In fact, after the economy over-tightening, unemployment and economic activities are very bad. The government passed the economic stimulus program, strongly increased market demand for services and products, and expand production in order to meet economic growth expectations. It seemed good, but after inflation has expanded, what we are going to face is inflation. From the demand for copper and iron, you can find clues. These two products can reflect the demand of the real economy. Because copper is a material widely used in industrial, commercial, and residential electrical appliances, the prices of copper and iron ore have reached 5-year highs. Inflation is reflected in commodity prices, proof that the economy is growing. These commodities reflect manufacturing and business activities are growing at a very high rate. It is what the US government wants to see. But by adding the effect of the US dollar depreciation due to quantitative easing policies, it will increase the import price of goods, exacerbate the pressure of inflation. To control inflation, most people in the market expect the monetary policy tightening will begin in the near future. If monetary policy tightening, small and medium-sized technology companies will be most affected, as they need to invest a lot of money in research and development. Because of the interest rate hike, the borrowing costs increase. Will the old economy and industries return to as good as before? It really depends on the effectiveness of those vaccines and how fast people willing to take the vaccine. Now many people ask, should we shift investments in growth stocks to value or economy stocks? Right now, the market is waiting for what the Fed Chairman Powell going to say in next Wednesday FOMC meeting. The market want to see what is the criteria of increased interest rate. For now, the market's performance since February 17 already told you where the money go. Those electrical vehicle stock, biotech, 3D printing, cloud computing stock, ARKQ, ARKF get hammered. Even though today it's rebound a lot, it is lower than before. Look at material stock, energy stock, and value stock. What sold 2000 and what sold 3000? They are all strong. They all rise and break out to 1-year high. So the market is telling us where the money go. They like material stock, energy stock, and value stock, even under this rising 10-year bond yield environment. Personally, I do not feel that this is the beginning of bear market correction, because it is very rare to see those tech stocks decrease 30 to 50%. While at the same time, there are tons of material stocks, energy stock, and financial stocks back out to the 1-year high. Look at the VIX index. It is dropping. It represents the market is not free. If the Nasdaq 100 can keep hold at this level until next week, then it is more safe for the growth stock. For the growth stocks, it may still need some time to stabilize. Better to wait for them rise above 50-day EMA. On the other hand, what to buy right now really depends on your financial situation and personality. Growth stocks are more likely to be appealing if these things apply to you. You are not interested in dividend income from your portfolio, as most growth companies avoid paying dividends to their shareholders. You are comfortable with big stocks' price moves. The price of our growth stocks tend to be more volatile to change in future prospects for a company's business. When things go better than expected, growth stocks can soar in price. When they disappointed, high-priced growth stocks can fall back to earth just as quickly. You are confident that you can pick out winners in new industry. You will often find growth stocks in fast-moving areas of the economy, such as technology and biotech. It's common for many different growth companies to compete against each other. You need to pick as many of the eventual winners in an industry as you can, while avoiding the losers. Value stocks are more likely to be appealing if these things apply to you. You want dividend income from your portfolio. Many value stocks pay out substantial amounts of cash as dividends to their shareholders because those businesses lack significant growth opportunities. Paying out dividend is one way to get investors to look at those stocks. You prefer more stable price. Value stocks tend to see very low movements in either direction. As long as the business conditions remain within predictable ranges, stock price volatility is usually low. You are confident that you can avoid value traps. In many cases, stocks that look cheap are value traps, or cheap for a good reason. It could be that a company has lost its competitive edge, or can't keep up with the pace of innovation. You have to be able to look past attractive valuation to see when a company's future business prospects are poor. For those people who love value stocks more, right now we can increase the exposure in material stocks as Biden going to pass the infrastructure plan in May. The related ETF is PAVE. For market reopen theme, Boeing is also a good option as they get more Alpine sales. For those people who love growth stocks, Space ETF symbol UFO is still a good choice. As the economy open again, more demand from the sports channel. In longer run, it will benefit from increased demand of satellite internet for cars, office, and home. Another ETF called SCOL, as e-commerce will keep growing after this pandemic. Social media platform will benefit from more advertisement. Leave your comment below about which ETF or stock you would like to hear. Remember to like, share and subscribe this channel. See you next time.